Gold is moving in the wrong direction, falling as global growth slows and inflation remains high. In this video, I'm going to show you not one, not two, but 3 powerful, profitable ways to pick winning gold trade. The first strategy is for day traders, and it uses 15-minute charts to pick tops and bottoms in gold. The second strategy is my personal favorite, and it trades off 1-hour charts. And the third strategy is for longer-term traders who will only have time for trading off daily charts. But before we get into the strategy, I just want to take a minute to explain what I mean by gold moving in the wrong direction, because it is a very important concept. Now, what I mean is that there are 5 things that impacts the price of gold, and that's supply and demand, the value of the US dollar, economic growth, inflation, and trading activity. When economic growth is weak, that usually tends to be positive for gold because, investors are looking for a flight to safety or safe haven. And when inflation is high, that is also usually positive for gold because gold is often seen as an inflation hedge. But that hasn't been happening. And the main reason is because of the strong US dollar. Depending on when you watch this video, the dollar may be strong or weak, but please remember that the number 1 most important driver of gold prices is the US dollar and the market's appetite for US dollars. That matters more than anything else. For more gold trading fundamental tips, watch my 3 top tips for trading the gold video, which I included in the description below. Also, don't forget to subscribe to my channel for more trading tips on gold, Forex, stocks, and general trader psychology. Now let's get back to our trading strategies, starting with the 15-minute strategy for day traders. Then we'll cover the strategy for medium and longer-term traders. My 15-minute strategy is very simple and uses the Relative Strength Index, which is commonly known as RSI for short. RSI is an oscillator that is used to pick tops or bottoms. And for those of you that are not familiar with it, it is an oscillator that measures whether gold or any instrument is overbought or oversold. There's a more complicated explanation, of course, but all you really need to know is that measured on a scale of 0 to 100. And the reading of 7 to 30 is the one people focus on. Any reading above 70 is considered overbought, and below 30 is considered oversold. But selling as soon as RSI hits 70 or buying as soon as it hits 30 is usually a bad idea because gold, or any instrument for that matter, is usually rising or falling for a very good reason. So it can remain in overbought or oversold territory for much longer than many people can anticipate or even remain solvent. The much better way to trade RSI, or any oscillator for that matter, is to wait for it to turn lower before getting into the trade. Just a little bit of a filter to increase the accuracy. A much better way to use RSI to trade gold is to wait for RSI to rise above 70 and then close below 60 on the 15-minute chart before selling. Here's an example. Okay, let's start by adding the RSI onto your chart. You're looking at my Tradingview chart screen. And the way you add the RSI is you just click on indicators and you type in Relative Strength Index and it'll show up right away. So we add the Relative Strength Index, and this is the 70 level that I was talking about earlier as overbought. And this is the 30 level that I was talking about earlier as oversold. So if you remember, I said that typically as a rule of thumb, when RSI goes above 70, it's considered overbought. If it goes below 30, it's considered oversold. But if you looked at this example here and you actually bought gold as soon as the RSI dropped below 30, you would have had a little bit of a retracement, but it would have been, another continuation of a decline. Instead, using my strategy, what you want to do is you want to wait for RSI, if you're trying to sell, to go above 70, indicating that's moved into overbought territory. Then you want to make sure it closes below 60. So in this case, here, you can see the RSI measures right over here. So here the RSI on this red candle is 57.55. So it goes above 70 here. So this is where we go above 70. This candle is where we close below 60. So I'm just going to add my arrow here and show you that this is the candle that we're selling. We're selling at the close of this candle, which is basically $18.99. And then you may ask me, Kathy, where's my stop? Your stop should be at the swing high. So if we sell at $18.99, your stop is going to be at $19.03. So we're basically, let's say we've got a $4 stop. So we've got a $4 stop. Your first target should be $4 as well, $18.95, which is right around here. And then you can trail your stop for the remainder of the position, picking a much more accurate top and bottom than arbitrarily buying as soon as we go above 70. Here's an example on the short side. Here, you want to see RSI down here is dropped below 30. Here, we are closing at 40. So this is still a live trade where we're going long at 1888 with the stop here, 1885. It's about $3 stop. So this trade is still live. But if we take a look at this trade here, so here we close below 30 right here, and then we're above 40 right at this candle. So this is another long trade in gold. So you're going long at 1892. Your stop is actually the same candle at 1889. So basically a $3 stop. Your target is going to be 1895.75, which is basically 1896. So it does take a little while, but our first target's hit here, and then you can trail your stop with the remainder of position. So another highly accurate win here in gold. Now, when I show examples, I always like to show winners as well as losers. Here, we're basically going long. Here we have the RSI dropping below 30. And at this point over here, we're back above 40. So you would go long here at 1894, and it would certainly have stopped you out. But, with every single trading strategy, there are winners and losers. But you want to have a lot more winners and losers, and that's where it makes it highly accurate. So let's take a look at another example here. So here, you've got RSI above 70, and then RSI closes pretty much, below 60 over here. So you go short at 1905, which let me point to the candle again. 1905, you're going short. Your stop is at 1906, so it's very, very tight. $1 stop. And then the candle next, and it goes down $2. You definitely would have hit your first target. In this case, you would probably just hit your first target because it would have stopped you on the rest at break even. And so this is an example of how you manage the trade. So sometimes you get to participate in a very big move, like some of these examples over here. But sometimes you gotta be realistic. It could just be a shallow move as well. And having the first target and second target basically increases your chance of winning on both a short-term movement as well as a long-term movement. And then here's another example. We basically have the RSI go above 70, just marginally 70.29. So you wait for it to go back below 60, which is this candle here. So over here, you're going short, right over here at this candle. And the stop, so you go short at 1907, and the stop is 1911. So basically a $4 stop. So your target should be 1902, 88 or something like that. So basically your target is going to be hit somewhere right around this region here. So another positive trade. So we basically saw, I think, 4 winning trades and 1 losing trade, and that's basically the odds that you want when you're trading, looking for a trading strategy, especially on a day trading basis. So this RSI trick is a really cool way to pick higher accuracy short-term tops and bottoms in gold. My favorite way to trade gold, though, is to trade off of the 1-hour charts. Let's talk about that and then the longer term strategy. This strategy basically involves selling when the longer term trend and the shorter term trends are telling the same story. So that means that the longer term trend is bearish and the shorter term trend is bearish. Or if you're looking to buy, you want the longer term trend to be bullish and the short term trend to be bullish before entering into the trade. And what this does for you is it basically helps you get into a fresh change in momentum, or, on a retrace/relief rally. That's what ZIP is about. As you can see here, the background is red, which reflects a bearish longer-term trend. And gold is trading below the indicator line, showing you that the short-term trend is also bearish. What you want to look for is those white candles, which are the entry signals. So basically, with the ZIP strategy, which trades off of 1-hour charts, when you see a white candle form, and it forms when the background is red and the instrument has moved from above the indicator line to below the indicator line, that's when you want to sell. So you can see here, if you sold gold right here on the sell signal, very nice precursor to what became 1906 to almost 10-point move lower in gold. Of course, we wouldn't have participated in this whole move. Your stop should have been, above the swing high, maybe targeting this move here, but it was a very good signal to get you into a short trend. Here's another one. I love it when we have 1, 2, 3 triple zip sell signals here. So triple zip sell signal, you would have sold, your stop, would have been, usually my stop is $10 in gold. And you can see this also becomes a very, very nice move lower. With gold, I like to have a 10-point stop and usually a 5 to 7-point first target, and then you trail your stop on the remainder of the position. Here are also 2 other, zip gold sell signals. The first signal would have gotten you in here with the stop up here. It never went back up to stop you out. And once again, a nice short signal in gold here as well. And you keep looking back. Here, we also have another really nice short signal formed by the white candle. Here, you probably would have gotten in earlier here, although if you sold here, it would have been 1936. And if we had a target of about 1930, that would not have been hit before the third signal formed. So you would have still been in the trade, but eventually you would have hit your profit target. But so far, we've had like 3 or 4 trades, all of which are winners. And here's another one. As soon as the momentum shifts negative, we've got a longer term bearish, shorter term bearish as well. White candle forming, beautiful drop in gold from 1958 all the way down to 1941. Definitely would have hit first and second target here. No signals over here. This is another beautiful short signal in gold. And let's see if we can catch, here's another short one. Here's another short one. So all very, very powerful signals in gold. And finally, we have a long signal gold here where the background is green and the gold goes above the indicator line, forming a white candle. So we go long here and boom, very, very nice uptrend here in gold as well. So, plenty of good examples in gold. Some of them are short moves, some of them are long moves. And ZIP is the indicator that I use to trade every day. If you want to learn more about ZIP, click on the link in the description below. Now, let's talk about the strategy for my longer term traders. For my longer term traders, I love using Bollinger Bands. Bollinger Bands are very similar to the relative strength index, where they're normally overbought and oversold indicators. But in this strategy, we're using it a slightly different way. We're using the Bollinger Band to help us get into a fresh new trend trade, a fresh new uptrend or a fresh new downtrend. Now let's take a look at the charts to understand what I'm really talking about. So typically when you put Bollinger Bands on your charts, the 20-period moving average is the outside line, and that's the default. So what I've done is I've added in the first standard deviation Bollinger Band, which is the inside line. And what I like to say is that when gold is trading in the 1-2 band, the downside, it's in the sell zone. When it's trading in the upper 2 bands, it's in the buy zone. Everything else in between is no man's land or the range trading zone. So the way this strategy works is that we're not using Bollinger Bands to pick tops and bottoms, which is the way they're designed to be used. Instead, we're using Bollinger Bands to catch a new downtrend or a short trend. So what you want to do is you want to see gold trading in no man's land between the 2 inner lines. When it's trading no man's land and it closes below the first standard deviation Bollinger Band, the first inside line for the first time, that's when you want to sell. You want to sell with a stop, somewhere up here, usually 10 pips is probably, $10 is probably good. And then you close your position at $5 to $7 for the first half. It's negative risk reward, but you want to lock in profits in case gold does not move as much as you'd like, and then you trail your stop in the remainder position. You could also try to go for more. That's where you can add your own creativity, but I just want to show you a strategy that works really well. So here we're closing below the first standard deviation Bollinger Band, indicating that gold has entered into a new downtrend, so you sell. And then you can see that gold, moves very, very nicely lower in this case. And then here, we also have gold having been in no man's land, where the last 2 candles were in the range trading zone. Gold pierces above the first standard deviation Bollinger Band. We go long, and at 1957, and then you can see another nice move higher as well. Here, we have a nice short trade in gold as well. In this zone here, We have one short trade here, which probably would have been stopped out, but then you would have caught the second one, but that's okay. This one becomes a nice winning trade here. It goes from the no man's land, closes below the first standard deviation Bollinger Band, and basically drops from 1982, wow, all the way down to 1959. So a very big move lower in gold. Here's another move here from 2016 all the way upwards. This one you would have gotten in at 2034 and still would have made 10 points at 2048 if you're greedy enough to take 10 points. Here, this would not have worked out, but that's okay. You have winners and losers, but you want a strategy that has a lot more winners and losers. Here, really nice buy signal. Here, this one you would have regardless kind of stayed in. This is probably what the trade you would have taken. This is the trade you have gone long, and then it took some time before it really broke out to the upside. This is a clean buy signal where we have been in the range trading zone. It closes above the first standard deviation Bollinger Band, and you're catching a new uptrend in gold. And here, you're selling when it drops below the first standard deviation Bollinger Band, catching a new downtrend in gold. As you can see, putting the Bollinger Bands onto the charts helps you use them more effectively to pick, those longer term uptrends and downtrends in gold that can lead to 10, 20, 30, 40, 50 points in gold if you have that much of a breakout in a high volatility environment. I just shared with you 3 of my favorite gold trading strategies. All I ask in return is that you take 2 seconds of your time and like this video. If you want to stay up to date with my future strategies, make sure you subscribe to our channel and don't miss my next strategy for trading gold and Forex.